All right, good morning, everyone. Thank you for joining us for our third hot topic session this summer. Today, our focus turns to the National Flood Insurance Program, or NFIP, which is managed by the Federal Emergency Management Agency. We titled the session Flood Insurance, Tidal Wave or Ripple, because the question really comes down to, with all the proposed changes that you may be hearing about, should realtors and property owners expect a tidal wave of changes or just a ripple? This topic is important to us in Delaware, especially because we have the lowest mean elevation across the entire United States. As a reminder, this session is being recorded for future access. We also welcome your questions, as I try not to make this too scripted. So please type your questions into the comment box, and I'll try to get to all of them at the end of the session. If you'd like to speak, I could also unmute you. Just let me know, type in you'd like to ask a question, and hopefully I'll be able to get to it at the end. Further, in case you're unfamiliar with Zoom, at the top of your screen, you can see a view button. You may change the view of what you're watching. You can have it highlight the speaker only, or you can view everybody that's in the room with you here today. So our special guest today is Austin Perez of the National Association of Realtors. Austin is the Senior Policy Representative for Federal Housing, Valuation, Insurance, and Commercial Issues. Welcome, Austin. Everyone is well aware that there is a private market for flood insurance, but millions of small businesses and homeowners depend on NFIP, which has been a federal program since 1968 to protect their property against flooding, which is the most common and costly natural disaster in the United States. So, Austin, welcome to Delaware. Let's start with the basics for our new members who may not really know what NFIP is and how it fits into the insurance marketplace.
Thank you. I appreciate the opportunity here. It's always a privilege and a pleasure to address the members, like Wes said. And thank you very much for having this very important conversation. So I am one of the policy analysts. I'm the policy lead on flood insurance. I'm the guy that wasn't in the meeting when they were handing around the flood insurance hat. And I enjoy the topic, but it's a very rich topic. But I certainly enjoy it and always look for an opportunity to share what's going on. So. Can people see the screen? Okay, good. All right. So by way of background, National Flood Insurance Program, it's a federal program. It was created in the 1968. It actually really didn't get running until 1984 with some statutory and regulatory changes. It is a federal program. What's unique about the flood insurance program, first, it's the only, other than terrorism, it's the only insurance program of its kind at the federal level. I mean, most other insurances are regulated at the state level. Think, property casualty, think your insurance, most of that is regulated at the state level, but flood insurance is one of those areas where the private market fails to provide sufficient quantities of flood insurance. And so a decision was made, rather than dealing with floods after the fact. In the 60s, the flooding, hurricanes were getting worse and worse. And every time you would have a flood, the federal government would come in and rebuild all the dams and levees and rebuild all the properties, and you have an even bigger flood. And so a decision was made at the federal policy level back in the 60s that we really need a proactive program of flood insurance in order to try to front load the problem rather than reacting to. The federal government really wanted to get out in front and be proactive. So they set up this program. Not only is it unique and it's one of the few insurance programs the federal government runs, but it's also a partnership between the federal government and counties, which actually manage the program. So they do the management of the flood mapping, the floodplains, the building codes. All those standards are done at the local level, the floodplain ordinances. In order for a local government to participate in the flood insurance program and provide access to this national flood insurance program, you as a county have to agree to meet a certain minimum level of standard. So when you build new, you have to build above the 100-year flood, that sort of thing. Secondly, the program, the federal government doesn't provide the insurance. It's provided through private insurance carriers that partner with the flood insurance program. This is called the Write Your Own program. The basic idea is that these companies come in and they essentially just issue the policies. The policies are written by the federal government. All of the details of the claims and the terms of the policy are all set by the federal government, but the companies come in and they provide the product, and they get a small commission in their expenses covered for that. And they also adjudicate the claims working with the private sector. So you've got a partnership between the federal and local governments. You've got a partnership with insurance agents, which really have no skin in the game. They're just providing a federal product in exchange for a very small margin of return. So this is a really kind of a partnership unique program, which explains why there are a lot of complications. And when you pick up the phone and you call someone like an insurance agent, or you call FEMA, or you call your local government, they're not all saying the same thing at the same time. So this is a very complex program that requires a lot of different people to be on the same page at all times in order to run the program efficiently. And which brings me to the topic of today. I'm sure a number of you saw the USA Today article. The folks in Delaware, obviously, with the President of the United States being from the state of Delaware, wanted to do a very sexy kind of news story about dramatic rate increases, and they found a study which we actually think a lot of a study, but they sort of jumped the gun and suggested that Delaware was going to bear the brunt of these insurance rate increases. And so I've been asked to come in and talk a little bit about some of the changes coming to the National Flood Insurance Program, and also just to assure you that with the news, there's sort of a slang term, which is if it bleeds, it leads. And so when you hear these horror stories about all these insurance rate spikes and everything, take it with a grain of salt. This is the news media doing what they do. The narrative they want to tell is that a lot of people aren't going to be able to afford their flood insurance, which I think after this presentation, you're going to be able to walk away assured that that's not going to be the case. But so let's get into it. So, right off the bat, what was it? Ripple, or what was the other thing? Ripple, or so this is a ripple. This is a ripple. I'm gonna, you may disagree with me after listening to this, but I think this is more of a ripple than the other thing. So, all right. So let me, I guess, step through the program. I talked about how complicated it is. The reason why, I think part of the reason why it's so complicated is because the program was created 50 years ago. And so think about, just in terms of your business practices, those of you who've been in the business for a while, I mean, think about if you were serving your clients with technologies that were 50 years old. Before there was a personal computer, before there was a handheld device, when the MLS was a phone book, when most of the calls from clients were coming in through payphones, and there was a cigarette container with coins in order to feed the payphone in order to get back to clients. There were no lock boxes. Essentially, you had someone on call, the agent on call, who would take the call, and then they would, find the right person who would go out and show the house. So, think about 50 years ago, all the advantages that we've seen in this industry over the 50 years. Well, the flood insurance program has been operating under 50-year-old technologies. And the reason why that is because it's very difficult to change things in Washington, D.C. Congress doesn't focus on things until it's a crisis. They're usually dealing with multiple crises at once, which means that they're triaging. So the flood insurance program is supposed to be reauthorized once every 5 years, meaning not funded, authorized to write insurance, and that's supposed to come once every 5 years, but it ends up being once every 10 years or once every 12 or 13 years, which is why you hear about, oh, we're going to have another short-term multi-month extension. It takes that long for Congress to get together and figure it all out and get a consensus so that they can move the latest set of reforms in the next 5-year reauthorization. Similarly, on the regulatory level, agencies care about lawsuits. And so in order for them to issue a regulation, in order to change a program, it can take 4 or 5 years. There's a very strict set of requirements that they have, which means that they have to go through notice and comment rulemaking. So they have to issue a proposal, they have to take feedback from the public, then they got to take all the feedback, and then they've got to come up with the final rule and issue it, and then it becomes effective. So things move glacially slow in the federal government, which is the reason why FEMA is just now getting to the point where they know that their program created in their pricing system created 50 years ago, they know it is not equipped to handle 21st century flooding challenges. And I start out with this slide because these are 3 separate properties I give you right here that are all in the lowest risk X zone, but they have all flooded multiple times. And I've given you examples of this. So the prices they're getting is $500. But the cost that they're paying out, the claims, the amount of times the federal government is paying out in order to rebuild these properties is quite a bit higher than that. So the program is, and also because of this, the program has borrowed nearly $40 billion just in the last 15 years alone. There's been some of that has been forgiven. So right now it stands at $20 billion in debt. That's taxpayer funded. So that's you, me, that's everyone who pays taxes is covering the $20 billion, which is not being made up through the policyholders paying appropriate premiums. All right, so before I get into the new changes, I want to talk a little bit about the old changes. And I want to go back 10 years. This all came to the head the last time the federal government did its last major 5-year reauthorization and reform bill. They decided to slip a little provision, and I'm not going to point any fingers, just so you know, no one saw it coming. It was sort of a middle of the night kind of thing where they were able to get this big bill attached to an even larger transportation bill. And there was a little 1-sentence provision that was a part of the flood program that essentially said, whenever you buy a property, you can no longer assume the previous policyholder's insurance premium in policy. So in other words, no more subsidies at point of sale. And so it became very clear in 2012, 2013 timeframe when people were trying to sell or buy a home, and they tried to do what they've been doing for the last 50 years, which is just, take over the policy of the previous owner, which is usually pretty cheap. That was no longer possible, and so they could go to the insurance agent. The insurance agent would quote them $30,000, $40,000, $60,000. So I'm going to talk a little bit about some of the problems and the reasons for this in this 50-year-old pricing system. But as we talk about what changes are coming, I want you to keep in the back of your mind, it's not new system or rosy old system. It's not more expensive flood insurance or cheaper flood insurance. The current system is a problem. And you could very easily see a $60,000 flood insurance rate for a $250,000 property, which, just think about that. That would mean the actuaries estimate that the property will be washed away once every 4 years. How many of you have sold or helped buy or sell a property that's extremely high risk, highest risk flood zone, that is being destroyed once every 4 years? So, but that's the price that's set for a number of these properties under the current system. So as we look ahead to what the new system, keep in mind, A, the old system is antiquated, it's a half-century old, and B, it can come up with some pretty ridiculous results, and I'm about to go through some of these results. 50-year-old system, you can have properties right across the street from each other, and you can see a factor of 5, 10 difference in the premiums. Now, I think we all on the Zoom here would be able to figure out for ourselves that the risk probably hasn't changed that much going across the street. The property across the street with the $66,000 premium is probably just as risky as the property with the $400 premium. But 50 years ago, we had cliffs. If you're in the flood zone, you pay a significant price. If you're outside the flood zone, you pay less of a price. So that's one problem, which is cliffs. Second, which I alluded to in the opening here, you've got a lot of properties that are paying quite a bit less than what they're paying out under the system. Generally speaking, this is not perfectly accurate, but an insurance premium is based upon the risk to that property. So a company wants to break even on any property it insures. In general, it wants to set a premium that covers its costs, including a very large event spread out over a number of years. Insurance is an exchange. It's a policyholder agrees to pay a stream of premiums, of monthly or yearly premiums, in exchange for that insurance company coming in. If there's a major event, then those two things should offset each other in the long run. But as you can see here, this is a property that's got roughly a $2,000 rate, but Hurricane Andrew, it lost $60,000. It paid out $60,000+ claim. In Hurricane Florence, just 2 years later, it paid out $80,000. So, like if you think about $2,000 for 20 years or $2,000 for 30 years, you're still not covering even the first event. So you can see that there are a lot of properties that are being charged a lot less than what their risk is to the program. Another thing that's very interesting is you pay the same rate no matter where you are. There's basically only 2 rate tables in the program. It's a little more complicated than that. I'm boiling it down for us today, but essentially it's either high risk or low risk. So if you're sitting in Tampa, Florida, right on the coast, storm surge, which, I just got hit by a storm just a couple days ago, in Ohio, Columbus, Ohio, you see exactly the same rate. Whether you're in, just off the coast where there are lots of hurricanes, or whether you're off a river in the middle of the country. So this idea that everyone pays the same rate leads to cross subsidization, which means that the higher risk property owners are paying less of a rate. So everyone's paying national average rate. So the higher risk property owner should be paying up here, but they're actually paying here. Whereas the lower risk property owner should be paying here, but they're paying the national average. So you've got this cross subsidization where low risk properties are subsidizing high risk properties across the country. So that's another artifact of the current system. I don't want to go through it again, but the reason why this is this pricing system hasn't been updated in 50 years. And so 50 years ago, it was a very sophisticated, it was better than what any insurance company had, because no insurance company was writing in this space. I mean, it was state of the art. And I mean, the way I like to think about this is, how many of you remember Cutlass Supremes? Cutlass, the souped up Cutlass Supreme was the bomb back in the 70s. I mean, you couldn't get a better car than it. But what happened to the Cutlass Supreme? It went the way of the dinosaur. The same thing is true with the NFIP. Either it's going to have to modernize its pricing system, or it's going to go the way of the dinosaur, as more of the private market is getting into the space, and they're just running circles in terms of their pricing. They're actually taking the highest risk property owners, and they are charging them just a little bit less than the NFIP, and they are making bank, lots of money off of it, because the program is so out of whack between the prices and the actual risk to each individual property owner. And the last thing I want to mention here about this, not only is there cross subsidization going on between low risk to high risk properties, but also high value properties are getting subsidized by low value properties. So replacement cost value is not something that was a data set or a variable back 50 years ago. And so think about it. Say you have a flood and it's causing, roughly 20% damage to every property in the community. And you take $1 million property and you compare it to a much more average property, $250,000 property, and you just, take 20% damage, right? Well, so the lower value property, as you can see, it's a $50,000 hit if you have a flood that's causing 20% damage on average. Whereas the $1 million property, you've got $200,000 claim. So the program is paying a lot more to replace the $1 million property than the $250,000 or $100,000 property. So you've got all this cross subsidization going on because you've got national average rates that don't account for the value of the property. Everyone gets the same amount of coverage. Everyone is charged the same. And that is the reason why you can get a $63,000 rate for a $250,000 property, because it doesn't take into account that it's a $250,000 or $1 million property. So I can go on and on and on about the problems with the current Suffice it to say, the old system is broken. It needs to be fixed. One of the things that you may not be aware, so 2012, Bigger Waters Act happened. It was that little sentence slipped in the middle of the night that created all the havoc, including the tens of thousands of dollars of rates for relatively moderately priced homes. So what did Congress do about it? Well, Congress, triaged, and they had a crisis. So a lot of property owners were upset about the prices. And so Congress decided to, in less than 2 years after that, to come back with the Flood Insurance Affordability Act, the Homeowners Flood Insurance Affordability Act. So the problem was solved, right? Congress, got together, they talked it through, and they figured out a simple solution in order to fix the rates and all the problems with the system. And they delayed it. So essentially what they did is they took that $60,000 rate, rolled it back to $2,000, and then they phase it in until it reaches $60,000 in 10, 15, 20 years. And I mean, that's what Congress does. I mean, they don't do formulas. They delay things. They kick the can. So what you need to know is that the problems with the current system are coming back. They've just been gradually phased in over time. And that makes sense. Congress sets broad goals in objectives, statutes, authorities, and they leave it to the federal agency to figure out the details. And so until FEMA fixes its current pricing system, it's simply not going to be fixed. As a result of all of the issues and concerns that our members raised, NER took the step of creating a new committee, the Insurance Committee, just to fix this problem. So 10 years ago, the board of directors got together, created this new committee, and identified me as the staff executive. That was that meeting I wasn't able to attend, where I got the staff executive hat, and found 50 of our most knowledgeable experts, realtors, mentors from across the country, flood insurance back and forth, probably forget more than I will ever know in my lifetime, and put them all on this committee. And the first thing the committee told me to do is, we're going to sit down with FEMA, we're going to fix this. We're going to hire actuaries. We're going to actually go out and hire actuaries. And we're not only going to prove that there's a problem, but we're also going to give them the solution. And so that's what we set out to do. Thank you for the dues and the resources that you provide. We went out and we conducted a very expensive study, and we hired the best of the best of the actuaries. And you know what? FEMA not only agreed, but they hired those actuaries to fix this system. So the two things that you need to know before I get into what changes is, it's the first time in 25 years that I've been doing this where such a fundamental part of a program was scrapped because my clients wanted it scrapped. And also the first time that I actually had a federal agency essentially adopt the solution put forward by my client. So rate 2.0, risk rating 2.0, which is sort of the slang for the new pricing system, was actually the end result of a lot of back and forth between the Insurance Committee of Realtors and FEMA. And so that's what's being rolled out. So we've got a really good idea already, just being in this position, of what the changes look like. And you can already see the slides. These slides I just borrowed from various presentations that we've had over multiple years with FEMA. So let's get into it. Here are the changes. Well, actually, let's move on back. Let's get right into this. Okay. So what you need to know about the current system, not only that it's 50 years old and it comes up with some really crazy results, but essentially FEMA has 3 pieces of information to price every property in the country. Now, imagine with your clients, if they only had 3 pieces of information before they could sell or buy a property, or 3 pieces of information before the buyer could put an offer down on a property. Let's just say it's the address, how many square footage, how many floors. I mean, imagine that's all your clients knew, and you're trying to provide them service, you're trying to add value, and you're trying to help them. They can't show up at the property, they can't look at the property, they can't figure out whether it's flood risk or not. All they know are essentially 3 things about the property. So that's the current system. It's a national average rate that's set in the high-risk flood zone based upon 3 pieces of information. Low-risk flood zone, it's 1 piece of information, which is the reason why a lot of people don't voluntarily purchase flood insurance, because If you expect that your risk might be $50 once every 30 years, why would you pay $1,000 premium for a low risk property or a low risk X-zone policy? The only ones buying the X-zone policies are the properties that can grandfather get into the rate because they were built at a time where they can take advantage of the low risk rates forever. So risk rating 2.0 has now added 20 variables to the 3, and it's property specific. So again, I'm using this thing with your client. Imagine, your client wanted to buy a property and they're asking you about the school system. And you say, oh, it's a really good school system, right? They want to know about the school down the street, right? They want to know about the property specifically. They don't want to know whether there's 3 schools in the city or town or county. They want to know the nearest school. They want to know crime statistics specific to the property. They want to know about the neighborhood. They want to be able to visit the neighborhood. So that's what Rate 2.0 does, is it prices the risk for each individual property based upon 20 pieces of information. So I think the 3 biggest pieces of information, which is a change in the new system. 1, distance to water source, right? How far are you away from the ocean or river, right? Is your flooding risk is it from storm surge or is it urban flooding? Like Houston, which is a little bit off the coast, but it doesn't have the infrastructure in order to accommodate 5 feet of flooding in a short period of time. Second, what's the elevation of the property? Is it on a hill or is it in a valley? I mean, you would think that these are the kinds of things that any insurance company would be taking into account. I mean, obviously the property on the hill should be paying less than the property that's sitting below sea level. But under the current system, that's not the way it's done. Third piece of information. What's the value of the property? Every insurance program that I've looked at, including the state government, FAIR programs, California Earthquake Authority, Florida, every government or private insurance company, they calculate their rates with 2 pieces of information. 1, they figure out what is the cost per dollar per square foot of structure, or a value of square foot of structure multiplied by the number of square feet. And so this is that. It is essentially what is the value of the property times the amount of coverage times the cost per unit of coverage. And so this is now a system where they are going to be able to rate each and every property based upon the specific characteristics of each house. So you get away from that cross-subsidization between low risk to high risk, from low value to high value. All right, so this is the nationwide analysis, but I did look up Sussex. All this information is online. I'm going to give you a link to all this information so you can look at it for yourself. So the thing that you need to take away from this is everyone's rates are going up now every year under the current system. They're going up on average about $8 per year. So if there was no Rate 2.0, there was no reform, FEMA didn't do anything, rates would go up $8 per month for the next X number of years. So again, we're comparing the new system to what would happen under the current system. What's the status quo? Which is rates are going up for everyone, an average of $8 a month. So if you compare that with the new system, you can see right off the bat that 23%, the rates are going to go down. So instead of going up $8, 1 million policyholders are going to see a reduction, and it's going to be an average of $85 per month. So that's roughly $100 per month. That's $1,200 per year. So that doesn't happen in the current system. Everyone keeps going up $8 per month on average. Everyone pays the national average rate. 23% would see $1,000 per month premium decrease under the current system. 66%, you can see they're paying roughly the same. So under the old system, they're paying $8 per month. Under the new system, they're paying up to about $10 per month. So it's roughly a wash. So you start to get into the rates where the premiums are going up a little bit more than the current system. So 7% nationwide would see about double per month of what they're seeing. So, instead of seeing $8 per month increase, they're seeing $16 per month increase. But again, These are all based upon value and risk. So the ones who are seeing the increases are the higher risk, higher value properties. And then the 4%, let's focus on that 4%. So these are the ones that are seeing considerable rate increases, more than $240 per year. But the thing that you need to know is that about 40,000 properties right now today are seeing $100 or more per month increase. 40,000 seeing $1,000 increases under the current system. Under the new system, so they're seeing $100 per month, steadily going up, and they're going up to $63,000 per year. At this point right now, the highest single family home in the system is paying $46,000 premium for a $250,000 house. They're paying $46,000. So their rates, 40,000 of them are going up significantly each month. And the top rate is $60,000 per month. Under rate 2.0, the top rate will become $12,000. So even those that are seeing significant increases, $100 per month increases, they're going up to a lower number than under the current system. Instead of going up to $60,000, they're going up to $12,000. So at the end of the day, they're going up $40,000 less at the end of that glide path, that formula that FEMA created as rates increase. Another piece of good news about it is the rates stop. The increases, the 18 to 25% increases stop when you reach full risk. Whereas under the current system, most of the subsidized property owners are going up and up and up, and they have to actually provide an elevation certificate to get off the escalator to actually stop seeing the 25% increases. They actually have to hire an engineer, pay them $1,000 to come out to their property to document that the property is a low risk property, and then send that to FEMA. Well, a lot of people don't trust FEMA. They don't have the money. They don't have the $1,000 or $2,000 to hire the engineer. They don't know to hire the engineer in order to provide the elevation certificate. So their rates are going up and up and up. And the one thing that they can do, they may not know about, they may not be able to afford it, they just may not want to do it. And so a lot of property owners in the current system are not only seeing average increases, but they're seeing average increases that they wouldn't otherwise see if they didn't actually take actions. So in Sussex, I don't know what the pre-rate 2.0, how many properties are on the significant, the significant $100 per month increases. I don't have the before for Sussex County, but I can tell you that there are a total of 2 under rate 2.0 in the entire county that would see a considerable rate increase under rate 2.0. So, like from 40,000 down to, actually, I know the nationwide. So it's 40,000 are seeing significant rate increases under the current system. About 300 would see significant rate increases under the new system. So 40,000 down to 300 would see significant increases, and their rates only go up to 12,000 rather than 60,000. And the rates are phasing in over time. Congress, because it put into their formula, the rates can't go up more than 18% per year. They're not jumping from wherever they are now to 12,000 overnight. They're going up 18% this year, 18% next year, 18% the year after, until they go from whatever the rate, $500 to $12,000. So they're not seeing them overnight. Fewer of them are seeing it, and they're going up to a lower number. And that's everyone, every single family homeowner, no matter what value. The top rate in the program is $12,000 per year under the new system. All right, so what's not changing? Flood maps are not changing. Who's required to get flood insurance? Not changing. Whether you can assume, this was the Bigger Waters issue from 10 years ago, whether you can assume the subsidized policy of the previous owner, you can continue to do that. If your county is in the community rating service system and they get a discount depending on how much mitigation is done, all of that stays the same thing. Grandfathering stays the same. If you are mapped from a low risk to a high risk area, that's the same discounts that you get under the current system, you get under the old, you get under the old system, you get under the new. And the reason why that is because FEMA can determine its own prices, but they can't undo what Congress has passed into law. And so they have discretion over what they charge, but they don't have discretion over the things that Congress has said, like you can't charge any more than 25% per year. Or if someone is mapped from a low risk to a high risk zone, they can only see at most a 5% increase. Or so all of those kinds of things that are locked in statute, none of that changes. All that changes is what's the full risk rate at the end of all of those conditions and restrictions that Congress has put on FEMA. All right, so when is this going to happen? When is my client going to see their $1,000 premium decrease? So the new policies, the new book of business, someone who's never had flood insurance ever before, after October 1 of this year, they will be rated under the new system. Also, if you're an existing policyholder, you have a current flood insurance policy, if you want, you can come forward, and if there's a discount, if you're on, one of the 23%, the $1 million policyholders who would see a $1,000 decrease, you're eligible for it after October 1. It doesn't mean you have to. You can wait until everyone else phases in. If it's going to be more for you under October 1, you're not going to convert. You're going to stay under the old system until everyone converts. So for existing policies, if you choose, because you can't get a better rate on October 1, if you choose to wait, April 1 of next year is when existing policyholders will change over to the new system. And it will be automatically done. And another thing about that, no more elevation certificates. So you no longer, this is a seamless program where you have what private insurance companies, which is you have data sets. You don't need to have someone hire an engineer and email you information in order to give a rate discount. It automatically takes place whenever you renew, whether it's October 1 or April 1, it automatically takes place. So no more elevation certificates. You don't have to do anything. The premium is automatic. The other thing too is a lot of the reasons why people see significant rate increases under the current system is because the insurance agents make a mistake. You got 2 pages of questions that you got to ask a policyholder before you quote a rate. Plus you have to go to the phone book. Then you have to flip to the right rate table and look at the right column in the right row before you can do that quote. And if you get confused, then you have to go to FEMA through a submit to rate practices. And if you're in the flood zone, you've got a different set of questions than if you're outside the flood. So all that goes away. Every policy holder in the country, every insurance agent in the country under the new system will have to ask 5 questions. And 3 of those are voluntary. Those 2, square footage and the type of foundation are pretty much the only 2 pieces of information that an insurance agent is going to have to know. Everything else is automatically populated. So the agent will plug in, either in their handheld device or they'll plug it into their laptop and out spits an insurance premium rate. So a lot of the complexity, a lot of the issues, no more elevation certificates, no more making sure that the agents are asking the right questions, getting the right answers, plugging the information in the right places, looking at all of that is done after April 1 of next year. Everyone gets rated under the new system. All right, so like I said, the information is all online. And these are all the links, and I will provide a copy to Wes of my PowerPoint. And of course, I will answer any questions. After this, we will make sure you get your questions answered. NER is also having a town hall with FEMA in August. So if you want to participate in that, you want to ask your questions then, or you want to ask them any questions I don't get to today, you can ask me, or we can go to FEMA either before or August. So you're going to have a lot of time to review this information. And the good news about this is FEMA has no secrets. They've met with our insurance committee 6 times in the last year. They've given us the blueprint. They've given the public the blueprint. I mean, they actually took the extraordinary step of documenting in a 200-page document their new methodology. You can't find a 200-page document on the old methodology. I've had to learn it over the years. And so they provided examples, 20-page examples, but this is the whole thing. The new system, completely what variables, how they're using those variables, what data sets they're using. They've also provided state and county and zip code level analysis. That's where I got the 2 properties that would see a significant increase in Sussex County. All of this information is online, not only how they're doing it, but what's the impact down to the zip code level for each property owner. So with that, hope that, oh, I took a little bit longer. I'm sorry, Wes. I didn't need to take so long. I got tense and excited about this. As you can tell, I'm very passionate about this issue. So anyways, I'm really happy to take your questions.
Thank you so much, Austin. That was a fantastic presentation. We do have a couple questions here. If anybody has any more, feel free to wave your hand. I can unmute you, but I do have a couple in the comments here. So bear with me here. So the first one here, Austin, is how will this be presented to the public? Will it be a deductible decrease or a premium increase as it's presented to the public?
Well, so I mean, you're going to see your premium, whatever it is. You're going to see it. There is an annual notice where, by law, FEMA has to provide you with your full risk rate, which may not be the same as what you're being quoted because you're still a subsidized rate under the new system. So there will be those notices. So if the question is October 1, I'm paying significantly more than I should be under the old system. How am I going to find out that I am eligible for a significant premium decrease? The answer is FEMA is going to send you a letter, and then you need to talk to your insurance agent who's going to be able to quote you the new rate. If they can't quote you the new rate, come see me because we're going to go directly to FEMA on it. Now, the one thing I do have to mention about this, so this is pricing insurance is a big part of the flood insurance program. This is a big change. This is the largest change in the program's history. So you can bet there are going to be glitches. There are going to be problems. There are going to be some property owners who don't see the decrease immediately. It's going to take a little time and we're going to have to ask some questions. This is not going to be a seamless transition, but I can assure you this, any glitches or difficulties or questions will be only a fraction of what they would be in 10 years if the current system is allowed to stand. If you have to answer clients, oh, you're going to have to get a $60,000 flood insurance premium for a $250,000. So I can tell you that any glitches are going to be relatively modest compared to the current system. So if I didn't answer the question, let me, so how they're going to present it is they've shared all this information on the public. They've shared all the impact data. Insurance agents are going to start being able to quote as early as August renewals for the October 1 rollout for new flood insurance policies. You're going to get a letter if you're eligible for a significant premium decrease, so you can talk to your agent after October 1. So if I don't answer the question, please send me a specific question through Wes, however you want to get that to me, but that's how they're going to present the information.
The next question here is, what about owners who are in the process of considering refinancing existing homes? Will the flood price be based on current system or new system? And is there a grace period or overlap?
Yeah, so there's no, refinancing is not a trigger. And one of the changes that were made under the law back 10 years ago is point of sale is not a trigger. So your premium changes when you renew your insurance policy, and only when you renew your insurance policy. Well, it's actually if you get remapped into a zone, or you have an existing policy and you get a new one, or you buy a new property in a flood zone. So those are really the only three triggers, generally speaking. I mean, there's a few more, but those are the big three triggers. So if you refinance, it doesn't change anything. There's no need for a grace period. There's no need. Your premium is going to change when you renew your insurance policy. And like I said before, if you're going to see an increase, it's going to be phased in over time because that's the statutory restriction. So you don't see the jump to the full risk rate. So, in effect, it's a delay of the full risk rate until you achieve after some percentage of increases over time. So does that answer the question?
I'll let them tell me in the comments. But I have another question here from Lori. Lori's on the screen, and Peggy said yes to that last answer. But Lori, I'm going to unmute you. Feel free to ask your question here.
Yeah, so Delaware will be rated the same as Arizona? I mean,
No. So,
okay.
so that's the current system, and that's going away.
And how is that going to be determined? What states are how, is it by state, or is it, you mentioned square footage and foundation, but where does geography play into that?
So it doesn't. It's your specific property. So if you buy a flood insurance rate, it's going to be based upon specific details of your property. So like how many feet to the nearest river? How many feet to the ocean? Are you in a low-lying area? Are you in a are you on a hill? What's the value of your property? What's the replacement cost value of your property as determined by Marshall and Swift, which is what the insurance companies use as replacement cost values. So it's going to be specific attributes. Are you on a crawl space? Are you on a slab? So it's each individual property is going to be priced and rated individually under the new system. I was starting out by explaining it's pretty ridiculous that everyone is charged the same rate no matter where you are, no matter what your flood rate. So that's what's going away under the current under the new system. Is they're going to start rating each one individually based upon the specific risk and value of each individual property.
Okay, so that's all that the new owner would need to know, the exact square footage of the property. And now, does that get submitted to the private insurance carrier or the federal program? Is there going to be a great difference in rate between the federal program and private insurers? Because right now it's pretty significant. It's a lot.
Oh, yeah, well, of course, right? Because I mean, think about it. If your rate is based upon a nationwide average, the private company is going to rate you on your individual property. They're not going to need an elevation certificate. They're not going to ask you to hire a licensed engineer to come out and, you know, pull out their fancy rulers, because they want customers. They're providing customer service. So they're going to make it a simple and easy a process. And they're going to quote you a price that is specific to your risk, because if they're overcharging you, you're going to go with someone else. So what's going to end up, I think, happening under the new system is private insurance companies are not going to be able to price as attractively as the federal government. I mean, the rates are going to be probably not exactly the same. I mean, I can tell you millions of dollars and thousands of FTE employee hours, consulting hours were spent on this new system. They're using 5 different catastrophe models, which is sort of they model floods. You know, they take an area and they model floods over 1,000 years. They literally run a model over 1,000 iterations to see where the flooding happens and how frequently. So the private sector generally uses 1 model. The federal government's using 5. So this is not only going to be the way the private companies do, but it's going to be better than private companies, because they're going to be using more models, more data sets, more vetting, more people taking a look at the eyes to make sure that any sort of glitches are ironed out to the extent humanly possible. Now, are there going to be mistakes? Absolutely. There are definitely going to be. There's no such thing as a perfect system, but this is going to be much closer to the private companies, and it's probably even going to be quite a bit more accurate than the private companies. But don't tell our friends in the private insurance industry.
So
they're going to lose business.
Last question. So when does this form, I think you said April, for a new policy goes into effect?
So it's October 1 for new policies.
October.
So if you never had flood insurance before, it starts on October 1.
Okay.
If you've got an existing policy, it's April 1 of next year. So you've got a year to talk about this with your clients if you so choose.
Okay.
The complication is if your client can get a significant premium decrease, they will be eligible as soon as October 1.
Gotcha.
So you do nothing, April 1, it changes. If you come to FEMA or to your insurance agent, and it's whoever's quoting your homeowner's insurance policy should be able to get you the right place in order to price flood insurance. Even if they're not doing it, they work with companies that work with the flood insurance program, with the Write Your Own companies.
Thank you.
Thank you, Lori. So I have time for one more question here, Austin. I think this is a good one. This might be a sales pitch for everyone getting flood insurance, but it is, please explain when flood insurance is applicable. My insurance agent told me a storm must be named a storm before the flood insurance applies.
Okay, so how do I say this? How do I say this politely? Well, let me just say it. Anyone can get flood insurance anywhere at any time. I mean, there's only one exception. If you as a community refuse to participate in the local floodplain ordinances, in other words, you have to build to certain standards, you have to adopt flood maps. If you're one of the less than 1% of communities, it's a fraction of 1% of communities across the country that refuse to comply with the federal standards, everyone else gets flood insurance. So, I mean, I think, and I wasn't in the conversation, I could very easily see an insurance agent talking on, sort of a questioning going back and forth. And, the question is, okay, when's the federal government, when is FEMA going to give me my check, my disaster relief check, right? Most people assume the federal government will bail them out after a flood, and so they don't get flood insurance. Or they assume their homeowner's insurance policy covers it, which homeowners insurance policies do not cover it. You have to buy a supplemental policy, even if it's from the private sector or the NFIP, it's a separate policy. So I could envision a policyholder, a homeowner policyholder talking to their homeowner's agent saying, well, I flooded, why am I not getting my check? And they're saying, well, if there's a named storm, there's disaster relief available if you apply for it. Well, I can tell you disaster relief, most people are not eligible for disaster relief. You have to meet very strict income requirements. Plus you have to not have insurance in order to be eligible for it. And if you're eligible for it, the most you'll get is about $5,000. So, try replacing your fridge with $5,000 to cover all of the damage of any kind of flood when you apply for disaster relief. So very few get it. It's a very small amount. Most people are not going to be made whole again unless they get flood insurance. You can get up to $250,000 of building damage coverage. You can get up to $100,000 of contents on top of coverage. And that's essentially the same thing as the private sector does. So anyway, I think they're talking about disaster relief. They're not talking about flood insurance. Flood insurance does not require a disaster to be declared by the President of the United States. If you have the policy, you're eligible for flood. I mean, to make a claim and get reimbursed for damage. And I mean, I could go into the claims process, but you probably don't want to know that. But I'd be happy to go into what the claims process looks like. And I mean, that's the next area, right? We address the prices. Next, we're going to address the maps, and then we're going to address the claims. So this is just the beginning of a modernization process for the program.
Well, we'll have to have you back when that time comes, Austin. I do want to slide in one more question just because I think it's very relevant. Elevation certificates, are they still required until October 1st?
That's the best. This is okay. So the two complaints I get from members across the country, I get them in coastal states, right on the coast, inland, I get them everywhere. The two big concerns I get about the flood program. Why do I have to pay so much so someone can build irresponsibly in harm's way? That's the big one. That's taking care of rate 2.0. The second one is I pay for a policy, I pay for taxes. Why do I have to hire someone, spend thousands of dollars on an engineer to prove what we all know, which is the flood maps are wrong and my property is low risk? So that's the elevation certificate. Why do I have to, after I spend all this into the federal system, do I have to take this extra step and spend this extra money and hire this extra person to fix something that we all know is an inaccurate map? That all goes away under the new system. It goes away for new policyholders on October 1. So anyone who decides to come forward after October 1 for a brand new flood insurance policy, they're not required to provide an elevation certificate. It'll still be required for floodplain management for the flood maps, not for pricing for a quote from the flood insurance program. So after October 1, new book of business, no longer need an elevation certificate. April 1 of next year, if you've got an existing policy, after April 1 of next year, you're no longer required to provide an elevation certificate. Now, one caveat I should make, sometimes the data set that the federal government has can be improved. Maybe it's based upon 5-year-old, 10-year-old data. So if you got an elevation certificate because you had to, maybe you were substantially damaged in the latest flood, and so you had to build to a higher standard under the flood program requirements, and you had to get an elevation certificate to prove that, you can provide that elevation certificate as an option if it'll improve your rating. You can also provide that elevation certificate, and if you can't get the better rating, I mean, if it's better not to have the elevation certificate in the system, you get the lower of the two. So the elevation, you don't get penalized for providing it's not required, but you don't get penalized if you voluntarily provide it. You get the best rate no matter what. So it's better for you to provide the elevation certificate because it just may be that you have more current data than the federal government has. So that's an option. And again, I can get into the specifics as we get into the system. We've got a year in order to figure this all out. It's going to take a little time to roll this all out. So I heard last question. I really appreciate everyone's time. I'm here to represent you. I think we've got some good news that you're going to be hearing a lot more about, but I'm welcome any questions, and we're going to have more conversations with FEMA. And so thanks for all you do. Thanks for your time. We just really appreciate the opportunity.
Thank you so much again, Austin. We really appreciate you joining us today. Just so everyone knows, this recording will be posted on our YouTube page. You can access that through DelawareRealtor.com. Our brand new website is up and running. Check that out when you have a moment. Also, just so everyone is aware, we're going to skip a hot topic session in August, and in September we'll do an appraisal evaluation forum. We don't have a date for that yet, but that will be the next session we have. So thank you again, everyone, for joining us. Thank you, Austin, and have a great summer, everyone. Bye-bye.